Right now, somewhere, a bank is about to lend out money it does not have. Not doesn't have on hand, doesn't have at all. It doesn't exist. Nobody deposited it, no printer made it, no vault holds it. The bank will type a number into a screen, and in that moment, new money is born into the world, and you will owe interest on it. This isn't a conspiracy theory. It isn't fringe economics. It's taught in first-year finance textbooks, confirmed by central banks in their own official publications. And almost nobody understands it, including plenty of people who work in finance for a living. By the end of this video, you'll understand something most people never do. Why money and debt are actually the same substance wearing two different names. Why the 2008 financial crisis was really a money supply crisis. And why the next 20 years of banking are going to look nothing like the last 200. So let's break it down properly. How is money actually created? And who benefits when it is?
Here's what most people believe happens with a bank. You deposit $1,000, the bank puts it in a vault, digitally speaking, and holds it for you. When someone else needs a loan, the bank lends out your $1,000, charges them interest, and everybody's happy. The bank is basically a middleman, moving money that already exists from savers to borrowers. It's a clean story, it's intuitive, it matches how a piggy bank works. It is also almost completely wrong. Banks are not warehouses for money. They are not simply moving existing dollars from one account to another. Banks are quite literally money creation machines. And the loan you take out isn't drawn from someone else's deposit. It's manufactured on the spot the moment you sign. To understand how, we need to look at what a bank actually does when it approves a loan. Let's follow a real transaction. Grace runs a small hair salon. She wants to expand, buy 2 more chairs, hire an assistant, and needs $10,000 to do it. She goes to her bank, gets approved, and the bank deposits $10,000 into her business account. Here's the part that breaks people's brains. That $10,000 did not come from another customer's savings account. The bank did not take it from a vault. The bank did not have $10,000 sitting around waiting to be lent. The bank created it. It typed $10,000 into Grace's account balance and simultaneously recorded a $10,000 loan asset on its own books. 2 entries, 1 keystroke. Brand new money, existing nowhere a second earlier, now circulating in the economy, earning the bank interest for the next 5 years. This is called fractional reserve banking. Banks are only required to hold a small fraction of deposits in reserve and can create new deposits against a loan, holding reserves after the fact rather than before. One loan didn't move money, it manufactured it. Now let's see what happens when that money keeps moving. Let's actually run the math, because the abstract version undersells how wild this gets. Say the reserve requirement is 10%, a common historical figure. Grace spends her $10,000 on new salon chairs. The chair supplier deposits that $10,000 into their own bank. That bank is required to hold 10%, or $1,000 in reserve, and is free to lend out the remaining $9,000 to someone else. That $9,000 gets loaned to a new borrower, who spends it, and it lands as a deposit in a third bank. That bank holds 10%, $900, and lends out $8,100. That $8,100 becomes a deposit somewhere else, and the cycle repeats, $7,290, then $6,561, then smaller and smaller amounts, again and again. Add up every loan created across that entire chain, and Grace's original $10,000 deposit can theoretically expand into close to $100,000 of new money circulating through the economy, all traceable back to one original loan. That's the textbook money multiplier, roughly 1 divided by the reserve ratio. At a 10% reserve requirement, the theoretical ceiling is a 10x expansion of the original deposit. In practice, it's rarely that clean. Some money leaks into cash holdings, some banks hold reserves above the legal minimum, and modern systems, especially since 2008, often don't even use a binding reserve requirement at all, relying instead on capital rules and demand for loans as the real limiting factor. But the direction of the effect is completely real. One loan becomes many loans, and the money supply grows far beyond the original deposit. A single $10,000 loan just helped create almost 10 times that much new money in the economy. Multiply that across millions of loans issued every single day, and you start to see the actual scale of this machine.
Most people assume governments print money. That's not really true anymore either. Physical cash is a small fraction of the total money supply, often under 10% in modern economies. The overwhelming majority of money in circulation exists as digital numbers in bank accounts, created the exact way Grace's loan was created, as debt by commercial banks in the act of lending. Central banks, the Federal Reserve, the Bank of England, the ECB, don't hand out money directly to the public. They set the rules of the game. Interest rates, which determine how expensive it is to borrow, which determines how fast commercial banks create new money through lending. Lower the rate, borrowing gets cheaper, loans go up, money creation accelerates. Raise it and money creation slows. But central banks also have a more direct tool, one most people only heard about after 2008, quantitative easing. In a crisis, a central bank can create new money electronically and use it to buy assets, usually government bonds, directly from banks. This pushes fresh reserves into the banking system, aiming to encourage more lending when the normal lending machine has stalled. Between 2008 and 2015, and again during 2020, central banks around the world created trillions of dollars of new reserves this way, money that did not exist before the keystrokes that created it. Here's the sentence that should sit with you for a second. Almost every unit of currency in the economy exists because someone, somewhere, took on debt, either a private borrower or a government issuing bonds a central bank purchased. The money supply and the debt supply are not separate things. They grow together, by design.
This system is not how money has always worked. For most of modern history, currency was tied to something physical. Under the gold standard, a dollar was a claim on a fixed amount of gold sitting in a vault. Governments couldn't create unlimited new currency because every new dollar issued theoretically needed gold backing it. This constrained how much money creation could happen, which also constrained government spending, war financing, and how aggressively banks could lend. After World War II, the world adopted the Bretton Woods system. The US dollar was pegged to gold, and other major currencies were pegged to the dollar. This held for about 25 years. Then, on August 15, 1971, U.S. President Richard Nixon announced that the United States would no longer convert dollars into gold at a fixed rate, a decision made unilaterally, without congressional vote, in response to other countries cashing in dollars for gold faster than U.S. reserves could sustain. This moment is often called the Nixon shock. It effectively ended the gold standard worldwide and ushered in the system we live under today, fiat currency, money with value because governments declare it legal tender and people collectively trust it, not because it's backed by a physical commodity. This is the single most important date in modern monetary history that almost nobody can name. Since 1971, there has been no external physical limit on how much money the banking and central banking system can create. The only constraints left are policy choices, interest rates, capital requirements, and political will. That's not automatically bad. Fiat systems allow governments far more flexibility to respond to recessions and crises than a gold-backed system ever could. But it does mean the constraint on money creation moved from how much gold exists to how much debt people and governments are willing to take on. That's a fundamentally different kind of ceiling, one that can, in theory, keep rising indefinitely. For 25 years after Bretton Woods, money had a physical anchor. For the last 55 years, it hasn't had one at all. That single decision in 1971 is the reason the system we just described even works the way it does.
Here's a question that should be bothering you. If money is created as a loan and loans have to be repaid with interest, where does the extra money for the interest come from? The bank creates $10,000 for Grace. She owes $10,000 plus interest, say $11,500 total, but only $10,000 was ever created. The extra $1,500 doesn't exist anywhere in the system yet. For that interest to be repaid economy-wide, new money has to keep entering circulation somehow. New borrowing, new government spending, or velocity moving existing money around faster. This is one reason economies are structurally pushed toward constant growth. It isn't just a political talking point. In a debt-based monetary system, the money supply generally needs to keep expanding, or debt service becomes harder to sustain across the system as a whole. This is why the economy needs to keep growing shows up in every policy conversation. In this system, it's baked into the math, not just the politics.
Now, I want to be straight with you because I'd rather you hear the pushback from me than get it in the comments. Mainstream economists don't fully agree with the interest can never all be repaid framing from Chapter 6. Their counter-argument, money doesn't just sit still, it circulates. The same dollar can pay off multiple interest obligations as it moves through the economy multiple times in a year. New money creation isn't strictly required for every borrower to cover their interest because velocity, how fast money changes hands, can, in theory, cover the gap without needing constant new debt. That's a fair point and worth taking seriously. But here's the part that survives the pushback, and it's the part that actually matters. Even the critics agree that the money supply is overwhelmingly created through bank lending, that it's created as debt, and that the system requires continuous credit issuance to avoid contraction. The disagreement is really about why growth is required, not whether growth is structurally important to a system like this. And history backs that second point hard, which brings us to 2008. Everything we've described so far runs in one direction. Lending expands, money supply grows. But the same machine works in reverse, and 2008 is the proof. In the mid-2000s, banks were creating enormous amounts of new money through mortgage lending, much of it to borrowers who couldn't realistically repay. When housing prices stopped rising and defaults spiked, banks didn't just lose money on individual bad loans. They became terrified of lending to each other, let alone to businesses and consumers. New loan creation collapsed almost overnight. Remember, if most new money enters the economy through lending, then a collapse in lending is a collapse in new money creation. Credit dried up. Businesses that relied on routine short-term loans to make payroll suddenly couldn't get them. This is what people mean when they call it a credit crunch. It's not just a figure of speech. It's a literal contraction of the money creation machine we just spent this whole video explaining. Central banks responded with the quantitative easing we mentioned earlier, creating new reserves directly, trying to force the multiplier back into motion because the private lending system had seized up on its own. It took years to fully recover. 2008 wasn't just the banks were greedy, even though they were. Structurally, it was the money creation machine slamming into reverse, and it's the clearest real-world proof that everything in this video isn't theoretical. Every time new money is created through a loan, the bank earns interest on money it manufactured at essentially zero production cost. Borrowers take on the real risk. If Grace's salon fails, the debt is still enforceable against her real assets, even though the money itself was created from nothing. This also explains a pattern you've probably noticed without naming it. Asset prices tend to rise over long stretches that correlate closely with periods of expanding credit. People who already own assets get wealthier as new money flows toward buying them. People sitting purely in cash watch their purchasing power quietly erode. And this system is entering a new phase. Central banks in dozens of countries are actively researching or piloting central bank digital currencies, CBDCs, digital money issued and tracked directly by the central bank itself, rather than existing as private bank deposits. If that shift happens at scale, it could change who controls money creation more fundamentally than anything since 1971, potentially cutting commercial banks out of part of the creation process entirely, while giving central banks direct visibility into every transaction. Whether that's a good thing depends entirely on who you ask and how it's implemented, but it's coming, and almost nobody's talking about what it actually means for the mechanism we just spent 19 minutes explaining. Money was never sitting in a vault waiting for you to earn it. It's being created every day through debt. And the next chapter of that story is already being written.
None of this is meant to make you afraid of the banking system. It's meant to make you literate in it, because you're going to interact with this machine your entire financial life, whether you understand it or not. If this shifted how you think about your next loan, your savings, or your paycheck, subscribe, because next we're breaking down what actually happens to your money during inflation and why it hits some people so much harder than others.